Let's take a look now at a risk event for the week starting Monday, the 9th of August. For that, we're off now to DailyFX, and joining us from there is Daniele Sabin Hathorn, who joined us with a look at an event to watch out for and a tradable event at that. Danny, good morning to you. What are you watching?
Good morning, Jerry. Well, it's a bit more of a quiet week in terms of the data front next week, but we do have US consumer and producer price indexes on Wednesday and Thursday next week. Now, we know it's all been about central banks and inflation, and is it transitory, is it not transitory, and how are they reacting? So that's obviously going to be a big number to look at next week. Obviously, any dollar pair is going to be interesting, but for me, trading this next week, I'm going to be looking at gold. Now, for me, gold has been quite disappointing recently. We've got the chart here. This is the daily chart. We can see it hasn't really done much in the last month, 5 weeks. There has been 2 attempts at a breakout. These were then confirmed as false breakouts, but it's just been stagnating around this 1,800 line, slightly above it, slightly below it, just coming and going. There is no clear pattern. We've got no lower or higher highs or lows. It's just a constant sign of indecision, and that's what we've been seeing. So for me, looking at this inflation data next week, now, gold has been acting as a central bank inaction hedge. What does that mean? So it means that when the central bank was seeing higher inflation data and price pressures coming up, and everything was pointing towards monetary policy needing to be adapted, when we saw the Fed ignore this and stay on their dovish stance, this is when gold was picking up slightly. Now we see, if you look at the chart here, this is when this was happening in the month of May, beginning of June. We had all this data coming out, but the Fed was still very adamant that they weren't listening to this. They thought it was going to be transitory. Then we had this a bit more hawkish than expected meeting. That was obviously then corrected later on with the comments. But this is kind of the reaction here we had in June, when we kind of saw the central bank, and especially the Fed, kind of start to react to these pressures from the market, and especially from bond yields, telling the Fed that they had to pay more attention to this data. Now, looking ahead to next week, it might not be an immediate reaction, but if we see weaker than expected CPI and PPI data, the markets are expecting it to be a little bit weaker than last month. So if we see a weaker reading on this, but we continue to see the Fed pointing maybe towards a more hawkish direction, then that would definitely be something negative for gold. I'm looking around this area here, 1,760, 1,750. This is the area that we need to break if we want to see this significant move lower. Alternatively, if we see higher than expected reading, or a reading that's in line, but the central bank, and especially going into Jackson Hole this month, we see central banks still remain pretty dovish. They're still saying it's transitory, and they're still focusing on employment, which probably gives them a little bit of at least 1 or 2 more months to kind of stay where they are and decide, because the jobs data, they want to see a good few readings before they act. Then we might see gold picking up some momentum on the back of this inaction continuing. So that's kind of the way I'm looking at gold. As I said, it might not be an immediate reaction after the data, but it is a good setup to kind of hedge against what the central bank is going to do in the next month or so with this inflation data, and also the jobs data that's going to be coming out recently.
Danny, thanks so much indeed. Daniele Sabin Hathorn from DailyFX with a risk event for next week around US inflation. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.